Your credit score just dropped 40 points overnight. But the real story started long before you ever missed a single payment. Hi, I'm Anna Hart. I focus on one thing: understanding how money really works, because clarity is rare and confusion is expensive. Let's rewind. Because this didn't start with a late bill. It started with something you thought was completely fine, something most people do every single month without thinking twice. Picture this. You finally feel like you have things under control. You're paying your bills on time. You're not carrying debt. You're being responsible with your money. And one day, out of curiosity, you check your credit score. It's lower than last month. You didn't do anything wrong. Nothing changed. Except something did. And that's exactly where most people get completely lost. Here's what nobody tells you about your credit score. It isn't just tracking your mistakes. It's tracking a system. A complex, often counterintuitive system with rules most people have never heard of. And the scary part is, you can follow every piece of common advice you've ever been given and still watch your score fall. Let's start with the obvious one, because even here there's a twist. Payment history. 35% of your score. The biggest single factor. Sounds simple. Pay on time, score goes up. Miss a payment, score goes down. But here's the part that catches people off guard. A payment isn't considered late after a few days. It's not even late after 2 weeks. It's considered late after 30 days. That means if you miss a due date by 29 days and catch it in time, nothing shows up on your report. But the second it crosses that 30-day mark, it gets reported to the bureaus. And a single 30-day late payment can drop your score by 60 to 110 points, depending on where you started. Not a little dip. A cliff. One slip. 6 months of damage. And it's not even the only thing watching you. The second biggest factor is something called credit utilization. It accounts for 30% of your score. And this one surprises almost everyone, including people who consider themselves financially responsible. Credit utilization is the ratio of how much credit you're using compared to how much you have available across all your accounts. And here's where it gets counterintuitive. You don't have to be in debt for this to hurt you. You don't have to be struggling. You just have to use too much of your available credit at the wrong moment in time. Say you have a credit card with a $5,000 limit. You charge $2,800 on it 1 month. Nothing unusual. Travel, groceries, a few bills on autopay. You're planning to pay it off when the statement comes. But the problem is this. Your credit card company reports your balance to the credit bureaus on a specific date each month, usually around your statement closing date. And that report happens before your payment is due. So even though you paid it off completely, your credit report showed a 56% utilization rate for that month. And anything above 30% starts pulling your score down. Anything above 50% hits hard. You paid your bill in full. You did the responsible thing, and your score still dropped. This is where the system breaks people's brains. Because the assumption has always been that as long as you pay your balance, you're fine. But the bureaus don't see your payment. They see a snapshot, one frozen moment in time. And if that snapshot catches you right after a big month of spending, the picture it creates looks far worse than your actual financial reality. But here's the part nobody tells you, and this is where it gets genuinely dangerous. Most people who discover this problem try to fix it. And the most common fixes are exactly the wrong moves. The first instinct is to open a new credit card to increase your total available credit. More available credit means lower utilization, right? That logic is correct. But the execution creates new problems immediately. When you apply for that new card, the lender runs a hard inquiry on your credit report. That inquiry drops your score by a few points right away. Then, because you now have a brand new account, your average account age drops. Length of credit history makes up 15% of your score. A shorter average history means a lower score. The new card does eventually help your utilization ratio, but those benefits take months to materialize. The damage from the inquiry and the age drop happens immediately. The second common move is the opposite. Closing an old card you're not using anymore. Simplify things. Clean up the clutter. Sounds perfectly reasonable. But here's what actually happens. The moment you close that card, your total available credit shrinks. Your utilization ratio spikes because the same spending now represents a larger percentage of a smaller credit pool. And if that card was one of your older accounts, you just removed a key piece of your credit history. 3 different scoring factors take a hit simultaneously. This is where people who are actively trying to improve their score accidentally make everything worse. Not because they were careless, because they were following logic that almost works, but misses how the model actually calculates risk. And there's one more factor that almost nobody talks about until it's too late. Hard inquiries. Every single time you apply for any form of credit, a lender pulls your report. Each pull can lower your score by 2 to 5 points. On its own, that sounds manageable. But the hits stack. If you're shopping around for a mortgage and you let 5 different lenders check your credit over the course of 2 months, you've just absorbed a potential 10 to 25-point drop before you've borrowed a single dollar. There is an exception built into the system. If you make multiple mortgage or auto loan inquiries within a 14 to 45-day window, depending on which scoring model is being used, they get bundled together and treated as a single inquiry. Rate shopping is protected if you do it fast enough. But most people don't know that window exists. So they spread their applications out over months, thinking they're being careful, and every single one counts against them. The system rewards people who already know the rules. And here's the final piece, the one that ties everything together. Your credit score isn't a judgment of your character. It isn't a measure of how hard you work or how responsible you are with money day to day. It's a model, a mathematical prediction of how statistically likely you are to repay a future debt based on past behavior. And that model is built on data snapshots that can be days, sometimes weeks, behind your actual reality. Which means the version of you that your credit score describes is almost always slightly out of date, sometimes significantly out of date. Here's something that makes this even more frustrating. Different lenders use different versions of your score. There are dozens of FICO score versions, plus Vantage score models, and each one weighs the same factors slightly differently. The score your bank shows you in their app may not be the same score a mortgage lender pulls when you apply for a home loan, so you could spend months optimizing for one number, feel good about your progress, and then sit across from a lender looking at a completely different figure. The goalposts aren't just moving. They're on different fields. But the underlying factors that drive all of those models are the same. And that's where your focus belongs. The good news is that the same predictability that makes this system frustrating also makes it workable. Once you understand what it's tracking and exactly when it's watching, you can align your behavior with the model instead of accidentally fighting it. Pay your balance before the statement closing date, not just before the due date. That's the moment the snapshot gets taken. Keep your utilization under 30%, and if you're serious about optimizing, under 10%. Don't close old accounts just to tidy things up. Let them sit open and mostly unused. Space out credit applications and stay inside rate shopping windows when you need to compare lenders. None of this is a hack. None of it is gaming the system. It's just understanding how the model works and making decisions accordingly.